All right, I think, yes. All right. Welcome back, Josh. I am so happy to have you back, and I cannot wait to dive into this topic. You know already that it's rather near and dear to my heart. And to all the people that are listening, it is something that I found out about way too late in life. And I really have appreciated all of the learning that Josh has taught me on it. And I look forward to listening to him talk about life insurance today and how it can help you and your families.
Great. Thanks, Cheryl. Life insurance is one of the most misunderstood, but arguably foundational or important financial vehicles or financial products in the marketplace for most adults who have a spouse, who have dependent children, who have any sort of basic lifestyle. It's inarguably a necessity. There's a lot of misunderstandings and misconceptions, and conventional life insurance agents often don't help that. So we can dive in, and I'm prepared to go into just some basics, a few remarks, some practical applications, but I'd really like to get a lot of questions and points of clarification. So whether it's from the chat on YouTube, or if we have anybody in the Zoom conference with us, however you can get those to me, Cheryl. I really don't want this to become a lecture. And Cheryl, you're welcome to interject and either ask questions or add to anything. I'll begin by putting my screen on here for you. And like I said, I want to focus on the practical applications and definitions and the minutia of one variety versus another. That's not terribly interesting or compelling for this format. That's something, again, like I've had offline with a lot of your guests and clients, that's a better conversation to be had offline, talking about specifics. So the most practical and highest application of life insurance is as an income replacement tool. Income replacement. And the words I'll say about income replacement are as follows. Everything that you want in life for yourself and for the people you love is on the other side of your ability to get up out of bed in the morning and go to work. Whether that's owning and operating your business, whether that is your career, your job, however you make money, you have to be alive. I say that only partially tongue in cheek. You have to be alive to do those things. And if you die, you can't do it. And I've had the good fortune of working for a few nice companies over the years. And maybe you listening here, maybe you have a great employer and a great team. But I promise you, after you stop showing up, even if it's through no fault of your own, the paychecks will stop. So you need something to replace your income if you die before your time. And that is life insurance. So here's a formula. This is a really nice rule of thumb, give you a good idea of how much life insurance should you carry. I like to peg this to either your anticipated retirement date and or when your youngest child is in his or her early to mid 20s, and you can use either one of those. So let's say that I've got 20 years before I can conceivably retire, and my youngest child could be in a position where he or she could reasonably take care of his or herself. What that means is if I need $7,000 coming through the front door every month for my family to maintain their lifestyle, I should carry about $1.1 million of life insurance. So life insurance is really a calculation. Arriving at the right number is a function of how much income you need to leave behind and for how long. Now, a lot of people are fortunate enough to be able to get some life insurance through work. It's rare that you're able to get a strong 6-figure, and even more rare that you're able to get a legitimate 7-figure number through work. And then you have to think about your ability to maintain that policy on the same terms, even after you separate from an employer for whatever reason. So this is, again, a nice rule of thumb. I'm not going to dwell on this too long. This is something that we can go over one-on-one for anybody who's interested. But life insurance is best used as an income replacement tool. And I'm going to expand on that because each idea here is really key. So there's dozens upon dozens, and depending on how you look at it, even hundreds of varieties of life insurance. And I'll just talk about one in particular because it's the most simplistic among them. It's term life insurance. And what I'll say in general is that term life insurance is the most cost-effective income replacement solution for coverage during your working years. And that last clause, during your working years, is really operative. So we're talking about your late 20s, your 30s, your 40s, your 50s, even your early 60s, where you're working in earnest, you're in your prime earning years. This is typically the point in your life where your mortgage balance is at its highest, your kids are at their youngest and most dependent. So during your working years is an extremely operative and important concept in there. Again, income replacement solution. It's an income replacement vehicle or plan, and it's cost effective. How cost effective? Here are the rates for a $250,000 level premium term policy with a level premium for 10 years. If you're a 40-year-old man or woman in good health, you can get $250,000 of 10-year term for anywhere from $13 to $11 a month. Now, the figure that I used a few slides ago was $1 million or $1.25 million. Even if we multiplied these numbers by 4 or 5, and we kicked the term level out to 15 or 20 years, I just helped a 41-year-old man into a $1.25 million level premium term policy. The premium was $100.75 a month. So,
Gosh.
Yeah.
Max asked, why did you use the term legitimate?
Legitimate? In what sentence? Maybe Max wants to clarify. Let me know when you get some clarification.
Okay.
Yeah. So to digress, you can get a lot of coverage for not a lot of money. And that's the beauty of term life insurance. Now, later in life, there are some reasons that you might need life insurance beyond your working career. So Social Security is a big one, right? So let's say in retirement, we have in this household, the wife's Social Security benefit is $3,000 a month. The husband's is $2,500 a month. And between the two of them, the Social Security Administration is paying them $5,500 a month. But the husband unexpectedly has a stroke or a heart attack and he's gone. The wife doesn't just lose her husband, she loses the $2,500 a month. Or what if he dies 6 months before going on Social Security, right? So this is one application and one reason why a household might explore a permanent life insurance solution that has cash value. Almost all permanent life insurance solutions do. And this is a reason why you might carry some life insurance beyond your working years into retirement and beyond. And most term policies cannot go that deep into one's life expectancy. And if they do, it's the numbers don't work. They're not affordable. It doesn't make sense given what you have to protect. So if you are forward thinking, and in financial planning, we often do this, this is a plan that you might establish in your 50s or 40s with a view to retirement. So that's a reason that you might have life insurance beyond your working years. And again, term insurance might not be the best solution. We might explore a cash value / permanent solution. Paying off the mortgage. A year and a half ago, 2 years ago, rates were at an all-time low, and people, even retirees who had little to no earned income, were refinancing their mortgages. If you refinance a mortgage at 65 on a 30-year fixed loan, statistically, you won't be around at age 95, 30 years from now to pay it off. So if you want to keep that house in the family, or your untimely or your eventual demise will, and the loss of that Social Security income will impede your surviving spouse's ability to pay the mortgage and maintain the house, then again, that is another reason why you might start thinking about, how do I maintain life insurance coverage, or how do I get a life insurance plan now while I'm young and healthy that can solve some of these problems when I get to this stage later in life where you won't qualify for life insurance or it'll be cost prohibitive. Similarly, leaving a legacy to your heirs. If you want to make sure that all of the money that you've saved and accumulated, you're able to use for yourself in your lifetime, at the end of your life in retirement, but you want to make sure that your kids and their kids have something when you're gone. That's another reason why you might build up a cash value or permanent account earlier in life, and then a buffer against the stock market. So in a large preponderance of your retirement account balances in your 60s and probably into your 70s and maybe beyond will be in the stock market. And as we discussed last time around, it goes through cyclical ups and downs. But when the market's down, that's not a great time to make withdrawals from your stock portfolio. But what if you have tens of thousands or a couple of 100,000 saved up in a cash value account that earns a fixed rate that won't go down when the stock market goes down? You can withdraw from that and give your stock portfolio and your retirement accounts time for those prices to recover. So that's another reason why you might consider life insurance later in life. So I've talked at you, Cheryl, for about for almost 10 minutes. I definitely don't, like I said, want to avoid lecturing. Do we have any questions? Is there anything that you might add?
So Max misunderstood what you were meaning, and I answered him saying, because he says, I believe it was that it's hard to find a job that would give you a legitimate 6-figure income, but you meant legitimate 6 figures or 7 figures of life insurance.
That's what I meant. Yeah, that's what I meant. That's what I meant. Yeah, if I misspoke, yeah, thanks for clarifying. Right. No, some employers offer nothing. Some offer a token amount. It's usually 50,000 because according to the tax code, that on a group plan, they can write off the premiums up to that amount. Some will pay for you to have more. Some will merely give you the ability to get more through a carrier or a benefits provider that contracts with a carrier. It's rare that you can get more than $500,000 or $750,000. It's possible in different employers, different arrangements. Most people find that they have to go to a carrier or an insurance agent or some other kind of financial services professional to get all the coverage that they really need.
You briefly touched on cash value life insurance. Would you care to clarify that a little bit?
Cash value life insurance is a catch-all term for anything that's not term life. So term life will eventually, well, I'll back up a step or two. Term life insurance, the way it's constructed by most insurance carriers, is actually term life to either age 90 or age 95. And the technicality is, in the time from when you take out the policy to 95, there will be a period of time. Maybe it's 10 years, maybe it's 15, maybe it's 20, maybe it's 25, 30. I don't see many 35 or 40-year terms left in the marketplace. There might be 1 or 2 carriers out there. I'd have to check the guidance with my product specialists. But with that said, during that level premium paying period, whether it's 10, 15, 20 years, you have a level premium, you have a level benefit. After you get out of that level premium period, you switch over to what's called current charges, which you can theoretically pay to 95. They become incredibly cost prohibitive, totally exorbitant. So a term life policy is designed for you to pay for it and keep it while you have a level premium. And when you reach the end of that level premium period, 10, 20, 30 years from now, you will not keep it because nobody can afford or nobody would pay for those rates. By contrast, a permanent life insurance policy or cash value life insurance policy usually, I'm going to talk generally, has a level premium that's amortized through either age 100 or you can amortize it through a younger age. But you will have a level premium for a definite period of time, and you will have a definite life insurance benefit, and you will even have often a guaranteed cash savings component and maybe even a non-guaranteed extra component. So what you get there is the ability to have a permanent life insurance benefit that never goes down at a, that never goes down with a premium that never goes up, with the ability to recuperate some of your premiums or all of them or more of them in your lifetime through a cash savings account. Now, there's a near infinite amount of variations of what I just spoke about using different versions of cash value or permanent life insurance. It's not for everyone, and I think that's where people get tripped up. The whole debate of one versus the other is, to me, not a debate. It's a distinction. It's a difference without distinction. It's simply put, if you need to have the debate, then it's not for you. Probably most people in the marketplace can just get away with term, but there are very good reasons for many people to perhaps devote some of their cash flow toward that kind of plan. I will say that for those plans to work, you have to have a long-term goal and take a long-term view. And it's got to be to do something like what I shared with you. In fact, let me give you an example. Thanks for jogging my memory. I'm going to give you an example of a 40-year-old woman who seeds a $250,000 whole life policy that's paid up at age 60 with the intention of using it to supplement her income from age 62 to 70 so that she can put off Social Security. Okay, so we know that you can take Social Security anytime between age 62 and 70. And the longer you put it off, the more they'll pay, right? So here's an example of a woman who wants to delay Social Security as long as possible, but needs to have some income to help do that. So I'm going to put an example on the screen. So what this forward-thinking person does at age 40 is she gets a $250,000 policy with a level premium of $500 a month or $6,000 a year. And she's going to seed that policy from age 40 to 60. And then she'll have no more premiums. And what's happened is through dividends, her $250,000 benefits grown to over $300,000. She's put $120,000 into the policy. It's worth $154,000 and doesn't cost her anything anymore. So what she's going to do at this point is, rather than claiming Social Security at age 62 and locking into a low Social Security benefit for the rest of her life, she's going to withdraw $2,000 a month from age 62 to 70 from her paid up whole life policy. And all the while, she's deferring Social Security so that that Social Security benefit at 70, when she pays out, will be higher. So from age 62 to 70, she withdraws $2,000 a month from a paid up whole life policy. And then at 70, she goes on Social Security and something really cool happens. So again, this life insurance policy doesn't cost anything. She still has a cash surrender value, and she still has a life insurance benefit. So at age 89, her life expectancy when she dies, her family still gets an $89,000 payout at the end of her life. $24,000 times 8. She recuperates nearly $190,000 in her sick. Get another 90,000 or so at the end of her life. So she got 282 plus thousand tax-free value out of $500 a month for 20 years. So this is a really nice, interesting, smart way to use cash value life insurance that solves a lot of problems and enables you to get more money out of it. So that's one example.
Okay, so we did have a question in the chat, but before we hit that section, to build on what you or to ask a question on what you were just talking about, is there any stipulations that if this woman decided to move out of the country, would she still be able to make the payments or collect the payments? Would there be any?
Yeah, as long as you have access to a U.S. checking account, doesn't matter where in the world you live.
Okay, perfect. So Max asked about, and here's my favorite thing, starting life insurance for your child.
Okay. So life insurance for children is not done for the death benefit, right? You don't want, no parent is going to get a life insurance policy with the anticipation or the expectation of receiving the death benefit or the actual life insurance component. Unfortunately, it does happen, but that's not why you get life insurance for kids. One reason that you get life insurance for kids is so that they can take it into their adult life, and it's something that you've already figured out for them, so they can put their money toward other things or maybe just get some inexpensive term. Another reason you might get life insurance for kids is to build up a savings account for them. So that's a really good reason, because the returns inside of a cash value plan in most cases are guaranteed, and they're pretty attractive relative to the prevailing savings rate in the bank. I know we're in a high interest rate environment right now, but I suspect in the next 2 to 4 years that might taper back to historical averages. So I'll give you an example of what you might do. I'm going to use an example from my own personal life. In my family, we're expecting a newborn boy sometime in late August, early September. So
Congratulations.
Thank you. So I'll give you an example of a newborn boy. And if you were to save some money every month for this child, with the expectation of using it for anything really. So I'm going to put something on your screen and we'll go from there. So what we're going to do is we're going to get a $1 million face value life insurance policy. And this policy, we're going to pay it up between birth and age 18, right? Because at age 18, kids go off to college, and we have to be ready to pay for much more expensive things. So what we do here is what we see from age 18 to 19, premiums are done. After 18, there's no more premiums due into the policy. We have nearly $200,000 of life insurance cash value. And unlike a conventional college savings account or maybe some other kind of account, the parent who funded this policy has a free hand to use this money as he or she sees fit. Something else really important here that I want to bring to your attention, Cheryl, and for anyone else in the audience. This column here shows the year-over-year internal rate of return on the cash value. we've got a strong 5+% year over year growth on the cash value. That's this part. And it's tax free. So it's really difficult to find any investment or any savings program where you can get over 5% year over year on your cash, and it's tax free, and there's no volatility, there's no risk. Your balance will never decline. So this is a really cool example. Imagine, if by the time your child is, let's just say, 30 years old, and he or she gets married and needs to buy a house and starts having kids of their own, imagine the leg up at age 30 for this person. Their family's going to have almost $1.5 million of life insurance. You're going to have $365,000 of cash to put a down payment on a house, start a business, buy a third car, and you're still earning nearly 5% on that money year over year, and it doesn't cost anything because you paid the cost from birth to age 18. There's no downside, to make these numbers work. Yeah, I think this is probably like $700 a month to make this work, and we can scale those numbers down. We can do half, and even if we cut these numbers in half, we're still talking well over $180,000 of cash and $750,000 of life insurance. The internal rates of return are the same. So it's something that all parents with dependent children or kids who are still at home should definitely consider, perhaps in conjunction to what they're doing already or supplement to that. But it can be a really wonderful leg up to give your kids going into their adult lives or grandkids.
Right. So two caveats with that scenario. One, I wanted to bring up that people that have the whole life or these cash value policies are able to draw against it, pay their own interest rate back into the policy to put the money back. So there are people that use it, for example, to buy a car, and they, instead of paying the loan to the bank, they take the money out of their cash value policy, and then they make their car payment back into the policy.
Sure, and they have a free hand to pay as much or as little at whatever rate they want. Typically, one of the most common or simple ways to get cash value out of a cash value life insurance policy is to take a loan out against the policy. The loan is technically debited against the death benefit. So if, let's just say, you had a $300,000 policy with $100,000 of cash value, and you took out 50 and you died 6 weeks later, your family would get the 300,000 minus the 50 you took out, minus any interest that accrued in that time period. So get the better part of $250,000 in that scenario. Policy loans really don't have to be paid back. Policy loan interest that accrues doesn't really have to be paid back. It'll ultimately just be debited against the life insurance cash value, the life insurance benefit, better said, at the end of the insured's life. You just have to make sure the numbers work, and you don't have to put some money in to keep everything in force. But if you have a competent agent and your policy was designed properly from inception, and you know what you're doing, that probably shouldn't be an issue.
Max asks, why is it tax-free?
It's tax-free because for those who care, it's the Internal Revenue Code section 7702, specifically 7702B. The life insurance death benefit is tax-free in almost all scenarios. There are some extremely rare specific scenarios where it's not true. But for the purposes of this discussion, the life insurance benefit to beneficiaries, whether they're immediate family, extended family, or non-family, the life insurance death benefit is tax-free. If a policy loan is simply advancing the tax-free, the eventual death benefit that will be tax-free, the IRS can't tax something now that would have not been taxed later. So that's part of the technicality. There's another technicality called cost basis, where in any savings or investment, your principal or basis or cost basis is always returned to you tax-free, because you were using after-tax dollars. So between returning your basis to you and advancing the ultimate tax-free life insurance benefit, you should be able to structure a cash value life insurance policy such that you can get the money you put in plus more out of it tax-free by properly using withdrawals and loans that take into account your basis in the policy, as well as the available life insurance benefit and cash surrender value ratio or proportion. Again, I don't want to get too deep into the technical mechanics of it, but it's possible. And again, part of being able to do that is working with somebody who's competent and having a sort of goal in mind when you get the policy, so that you'll have the option to do these sort of things 10, 20 plus years in the future.
Max is excited now.
It's hard to be excited about life insurance. I've been doing this for over 15 years. So if I got him excited about life insurance, this might be one for the record books. So
Max says, love this advanced gameplay. Really shows the beginning of how far you can go with this. And Kim Marie says, sweet.
Cool. Yeah. Again, so much of financial planning requires a long-term view, projecting yourself into the future, thinking about potential complications that might be 20, 30 years away, but figuring them out now. As a rule of thumb, and investments and insurance and financial planning aside, if you can solve a problem before it even creeps up, you're going to save yourself a lot of headache and heartache in life. And that goes beyond just finances. It's just especially true in your financial life and in financial planning. The best time to address these issues was yesterday. Second best time is today. So,
can we talk a little bit about? So you went over what it looks like for a newborn with a whole life policy. Can we discuss? I may be misremembering, but term that we can turn into whole life convert?
Yeah, I'll just speak in the abstract on that one. Most insurance carriers who issue term life issue some kind of permanent life insurance, whether that's universal life insurance or one of its derivatives like index universal life or variable universal life, or they issue whole life or one of its variations, limited pay whole life, or whole life amortized to age certain that's not 100 or 99. So what most companies do, if they issue you a term life insurance policy now, they will let you upgrade or convert some or all of it to one of their permanent insurance products in the future. You don't have forever, usually of 5 or 10 years. And you won't have to go through medical underwriting. You simply pay based on your attained age at that time in the future. So this is especially good for younger people who haven't perhaps hit their stride in their career, or they're working toward their prime earning years and growing their comp or their income, to get some term life now and come back to this thing in 3 or 5 or 10 years and make a long-term plan like I described. The only other items of consideration is when you get a term life policy, understand how long you have to do that upgrade or conversion, and which products can you convert into or not convert into. You cannot convert into a product that the insurance carrier doesn't have. So there are carriers who issue universal life products, but not whole life products. There are carriers who issue all sorts of products, but you can only convert into one or two or three very specific ones. So you want to look for a carrier that's going to let you convert into the product that you would like to have now. Maybe it's too much of a stretch. So do those, make that investigation up front, because sometimes some of the most competitively priced, that is to say the cheapest premium term life carriers, have a very limited suite of permanent products. So it might be self-defeating, or you might split your business between a super low rate carrier and perhaps a more premium carrier, and leave the door open to make that decision in the future. So this is an example of not letting great be the enemy of good. I would encourage everybody on this call, especially if you're under 55 and especially if you're under 50, if you've got kids under 20 at home, I would encourage everybody to look at their current life insurance program, really do some calculations and think about, would this really be sufficient given the mortgage and credit card balances and auto loans and how many kids you're trying to put through college and all these things. If you're in Northern Virginia, if you're on any coast, East Coast or West Coast, $250,000 or $500,000 is almost certainly not sufficient. My clients here in the DC metro area, everywhere from Baltimore to Richmond and as far out west as central Pennsylvania and West Virginia, when we look at term life programs, we're looking at how many millions are we going to get? Maybe we'll get 2 million of 10-year term and 1 million of 20-year term, or some way that we're looking at between 1 and 4 million on average, because that's what it would take to pay off a mortgage and put 2 or 3 kids through college and grad school and pay off student loans that are still lingering, and make the family whole in the event that an income earner, a husband, a wife, a mother, a father dies before their time, dies during or before their prime earning years. It's a lot of money. It's a lot of money. If you gross $120,000 a year, $10,000 a month, that's probably $5,000-$6,000 of net income, after-tax income that's going to your family. And then you have to remember, what if you're the parent or the spouse that the health insurance goes through? You got to factor these things in, and there's so many invisible things that you never know until it's too late. And again, within the realm of reason, big caveat here, but it's really hard to have too much term insurance. If you make 50 grand a year, you probably shouldn't have $5 or $6 million. But if you make 150 grand a year, that's not out of the realm of possibility, or it's not unreasonable. You probably won't do it. It might not be totally suitable, but it's approaching there. It's getting there. So another effect of inflation. Cheryl, I'm happy to answer maybe 1 or 2 more questions. We've gone for almost 40 minutes. And again, we're talking about life insurance. So with the exception of our buddy Max here, I don't know.
We've actually got some excitement here. So
Okay.
Renee has a question, but before we get to her question, I did want to, you just kind of touched on it a little bit. I want everyone to understand that you don't get one policy generally. Generally, it's you work with someone like Josh, and they build a system for you. So it's different rates and years and things to get you coverage for different events.
Yeah, Cheryl, thanks for bringing that up. That's a good point. Most of my clients don't have one singular life insurance policy. We might have staggered term policies. We might have term in conjunction with a permanent program. We might have a fixed or permanent insurance product paired with a variable life insurance product that work in tandem with one another. So there's a lot of different strategies and methodologies for arriving at the right amount of coverage. You might need, if your kids are teenagers, right, you might need a lot of coverage over the next 10 years. You still need coverage over the next 15, 20, but you might not need as much. And that might be the case for getting $1 million of 10-year term and maybe $250,000 of 20-year term, or $1 million of 10-year term and $100,000 of some kind of permanent insurance. So there's all sorts of ways to skin the cat, and we could go on for hours and hours on end with a bunch of thought experiments. But I think just for the sake of getting that idea across, yeah, that's a really interesting point, an important point that you bring up, Cheryl. Thank you.
And Renee asks about indexed universal life, IUL.
Yeah, it's a product.
She just, as a product. She said, Did you already talk about it? I said, no, not yet.
Yeah, Index Universal Life has grown exponentially over the last 10 years. I believe its share of the marketplace has doubled and tripled in that time. There's a ton of thought pieces and literature that goes out there. I will say that one of the most underappreciated and misunderstood facets of all universal life-based products, it's conventional universal life, index universal life, and variable universal life, is that their rates of return are predicated on a prevailing interest rate from the insurance company that in the example of universal life is according to a schedule that's pegged to the index. Depending on how the index does, you'll get a fixed rate. The index doesn't perform, you'll get a flat rate, 0%. But the most misunderstood part is that even if you have a down market year and your cash value is credited with 0%, which means you don't lose money, that doesn't mean that your policy was free, because in all universal life products, you have an internal cost of insurance and you have internal administrative fees, what are called mortality and expense fees. You have a premium expense fee. It's a flat percentage off the top of every dollar you put in that they take. So it is possible, even if you have a 0% year, it is possible for your cash value to go down because of the internal costs. What's more, as you get older, those internal costs get much higher, because the most important cost in any universal life or universal life-based product is the cost of insurance, which is predicated on your age. So you have to make sure that as you fund any universal life-based policy during your working years and you contemplate withdrawals later in life, that there's going to be a requisite amount of cash value to cover your internal cost of insurance and other fees late in life, so that your policy doesn't implode and collapse late in life. And that is the number one misunderstood part of all universal life-based policies. There's a lot of excitement around this product in particular. I think in a large degree, it's unwarranted. In a large degree, there's actually nothing special about this product, and to think that it's the be-all end-all is way overstated. It's just a life insurance policy. And if you did the same thing with regular universal life or whole life or variable universal life, you could probably get the same outcome or better. I think people really get goosed on being able to get a decent return in the up market years and 0% in the down market years, the idea that you're never going to lose money. And that's not technically true. And I can show you mathematically 27 odd different ways that outside of life insurance, an investor who is fully invested in the market and suffers those market downturns and their balance goes down at the end of 10, 20, 30, 40 years, has way more money than the investor who gets a lower fixed rate in the up years and 0% in the down years. And that's before we even get into the internal costs inherent in the policy. So it has a place for plenty of people out there. We use it in my practice. and it's a fine product, but it is not the be all end all. And anybody who tells you otherwise, God forgive me for what I'm about to say, the whole infinite banking concept, it's just total fluff. It's just all, it's much ado about nothing. And frankly, it's commission driven salespeople getting over on people who perhaps put their trust in them and should have. And that's probably the most generous description I can give. So that's what I'll say on that. And that's not to say it's a bad product. Again, we use it in my practice. Plenty of our clients and policy owners own these kinds of plans, but we're using it for different purposes. We're not using it as the super ultra mega super secret tax loophole of the rich, infinite banking. Nobody wants you to know this. Like, honestly, if that existed, you wouldn't know about it.
All right. So we have been at this for 45 minutes now, and do we have any? So Renee says, okay, great. Thank you for this. Do we have any more questions?
I'm happy to take one more. We can just put a bookmark in it and schedule another time, perhaps 2 to 4 weeks from now, and talk about some other topic.
Yeah, definitely. So far, it's been very well received. People are watching the replays, and so I just want to, while I'm waiting to see if another question pops up, reiterate that Josh's information is in the I'm looking over here, but the camera's over here, is in the description below. You can reach out to him or you can reach out to me, either way, and I will facilitate getting you two together. He is absolutely phenomenal when you sit down with him and you put your information out there so that he can configure the best plan for you, your family, and your future. So that being said, we don't have anything else popping up right now. I very much appreciate your time, Josh.
Thank you, Cheryl. Thanks for giving me the venue and the medium to talk to you and your clients and your guests. And I'm happy to have a conversation in private with anybody who wants to take a second look at their life insurance program and see where they might be able to tighten it up and improve it. Or if you haven't gotten one done or haven't really been deliberate about it to date, I'm happy to get together and we can figure this thing out and move on to bigger and better things, building up a 7-figure investment or retirement account and getting out of working for a living and having those kind of conversations, which are much more inspiring and exciting than life insurance. But it's got to be done. It's totally necessary. So it's good to see you again, Cheryl, and we'll be in touch soon. Thanks.
All right. Thanks, Josh.
Bye.
All right. So for those of you that are still left, again, there are some questions that I am able to answer a little bit. I was involved with New York Life, and Josh was an instructor for me when I was there, and it was a very eye-opening experience. I know what Josh said about we don't buy life insurance for our children in the event of that we are thinking that they are going to pass away. But I'm going to get real with you guys for a second. I started my life insurance career it's the anniversary of when I started was about 6 years and 2 days ago. And it was on the heels of losing my son. He had been killed. And it was 25 years after having lost my daughter when she was 2. And my oldest daughter, her my grandchildren's father was killed early in life. There are these things that I know about and have experienced firsthand. And while money is not everything, it gives you the time to grieve. It gives your family the time to grieve. So love yourself, use it as a wealth building tool, love your family, have it there in case the unthinkable happens. And have that talk with Josh, or have that talk with somebody that, that you are already close to, and figure out what it is that you guys need to make that next step for your family. And on that note, I'm going to cut this one. And I hope that you all got a lot out of this. And if you have a specific topic that you would like Josh to talk about in the future, he will be back. He's very open to the discussions. So I appreciate that. And I appreciate you all being here. And thank you. Just reach out. Let me know. Bye-bye.